A dividend ETF that's really been catching my attention lately is TDIV. And no, it's not because all of a sudden it's been going parabolic. I actually first talked about this 3 months ago in this video right here. That was before the massive run up in technology. And even then, I was expressing excitement about the potential for this fund. But okay, let's back up a little bit, discuss what is this fund and why do I see potential in it for the right kind of investor. So the name here kind of gives it away. It is the First Trust NASDAQ Technology Dividend Index Fund ETF. So what exactly is this index? Well, the index includes up to 100 technology and telecommunication companies that pay a regular or common dividend. And that's basically it. It's a very simple index. Technology companies are given a collective weight of 80%. And those classified as telecommunications, 20%. It employs a modified market cap weighting methodology in which larger capitalization companies receive a larger index weighting. And if we come to the holdings of TDIV, right now technology is 87%, probably due to the massive run-up in valuations it just experienced. And these are the top 10 holdings. And there's a couple of ways to read this. I'm sure a lot of you guys right now are thinking that this ETF is terrible. It's not diversified. It's so heavily concentrated. And that is true. This is not a broad market dividend ETF. It's a specialized dividend ETF. So it does fill a different role inside of a portfolio, but that role is giving you exposure to high quality technology companies that pay dividends. So with this fund, you're either in Camp A, which is represented by this guy on Seeking Alpha. This is overweight in semiconductors, low quality, hard pass, or you're in Camp B, represented by this guy, Dividend Seeker, who likes their tech and dividends together. So a big criticism of dividend investing as a whole is that dividend paying companies are not fast growing companies. When you look at the holdings of more traditional dividend ETFs, I can certainly see the argument here. It feels like you have to pick between income and growth a lot of the times. But the holdings of TDIV are just a different story. You have a good mixture of growth and high yield. Now you could nitpick the holdings here and say Intel isn't a great company, I like Broadcom, I don't like IBM, Apple's good. But as we all hopefully learned in 2021, picking winners and losers, especially of technology companies, is kind of a nuanced, difficult thing to do. Something we do know is that companies that are dividend growers and initiators tend to outperform the S&P 500 over long periods of time with less volatility. And there's a couple of reasons that come to mind for this. One is that in order to pay a dividend, companies need to keep cash on hand. They also have to be disciplined to maintain and grow that dividend over time. I mean, for example, Meta doesn't pay a dividend, and in 2021, they wasted tons of money in the metaverse, money that could have been given back to the investor if they paid a dividend and were thus more disciplined. So by taking high growth tech companies and filtering by those that pay dividends, this could be a good strategy. Now let's move on to the performance. So based off of my research, these 5 dividend ETFs are the best performing on the market, and we're looking at the total return right here. Over the past 5 years, TDIV has a return of 81%, SCHD 70, DGRW 75, and then DGRO and Noble are a little bit less at 64 each. And across the board, this is phenomenal performance. If we benchmark this against the S&P 500, these funds are right in line with the S&P 500, which is the general benchmark, dispelling the myth that dividend companies have to be slow growing. And I think a big driving force behind the great returns of these specific dividend ETFs is that they have a high allocation to technology. So SCHD has 13.8% dedicated to technology, and the number one holding is Broadcom, a technology company. DGRW had the second best performance, and technology makes up 30% of its holdings. And the worst performing fund we had there, which still had great performance, is Noble. And this has the smallest allocation to technology at just 3%. So the data that technology companies tend to be a major driver of growth, plus The fact that companies that initiate and grow dividend also tend to have outperformance fully explains to me why these three funds in particular that focus on dividend growth technology companies have such great returns. And TDIV, being only technology companies, takes this idea to the extreme. But let's evaluate it. First, let's clean up the charts a little bit by deleting DGRO and Noble. And we're going to keep the S&P as the benchmark in green. So the first thing we can notice here is that during bull runs, TDIV does have the most price appreciation, even slightly above that of SCHD, although it is much more volatile. And in 2022, TDIV went from being up the most to down the most. But just for context, if you compare this against just the QQQ, TDIV was still much less volatile than the general technology sector. And I think that goes back to the data we saw that dividend paying companies tend to just be more stable. But even though TDIV was down the most in the depths of the 2022 bear market, with this recent rally in tech, it has appreciated the most, and now it has fully recovered and surpassed all the other funds mentioned here. So after presenting that data, hopefully in an unbiased way, what is your thoughts on TDIV? I'm still developing my full opinions here, but I gotta say, on a conceptual level, I love the combination of technology stocks that pay dividends. It's a really magical combination, in my opinion. You might not be a fan of all of the holdings. For example, I'm not the biggest fan of Intel and IBM being such large allocations, but the performance really speaks for itself. It has very competitive and even great long-term performance against other top dividend funds like SCHD and DGRO. I think if I was to add TDIV into my portfolio, of course, it would be in the growth section. And I might pair it with QYLG. QYLG is an exact mirror to the NASDAQ 100 with a 50% covered call strategy to earn income. And I think TDIV, giving you extra exposure to those companies that pay dividend within the same index, might be a nice combination and complement with QYLG. But keep in mind, this is not a broad market diversified fund, and that's why within my portfolio, this tech section is only a small portion. But yeah, let me know your thoughts in the comments below. Thanks for watching, and I'll see you guys in the next one.